All right, so with everything that's going on in the world and the government, you're probably trying to keep a little bit more of your hard-earned dollars in your pocket. So in this video, I'm going to talk about how to avoid paying taxes when selling your land. All right, so come along with me on a journey. I'm going to show you 2 tips that are going to help you avoid paying taxes to the government when selling land. All right, so the first tip is the homeowner's tax credit. You know, this is anywhere from $250,000 if you're single and up to $500,000 if you're married. This is one of the best tax credits that our government has given us. And guys, I'm not a CPA, I'm not an accountant, I'm not even a bookkeeper, so I'm not giving financial advice. I'm just sharing information that I've utilized in my business and my person to sell land for tax-free. The first thing, talking about single, $250,000, married, up to $500,000. What does that mean? If you're single and you sell a house that you've lived in for 2 out of the last 5 years, you will not pay any taxes on it as long as you claim it with your CPA. You want to talk to your CPA about this. If you're married, you can write off up to $500,000 worth of capital gains. So let me just give you a quick example. So you buy the house in California for $100,000 5 years ago. You live in it 2 out of the last 5 years. You sell it in that same time frame. If you're married, if that house went up to $600,000, you would pay no taxes on that $500,000 gain. All right, so let's do a single example. If you buy this California house for $100,000 and it goes up to $350,000, so you bought it for $100, it goes up to $350, and you sell it for $350, and you lived in it 2 out of the last 5 years, you're going to get a $250,000 increase in value, and you're not going to pay capital gains on that because you're eligible to write off up to $250,000 of that. But where does land come into play, right? You're asking about how to save money on taxes or how not to pay taxes when you sell a piece of land. Let's just say, for instance, that property that you purchased was 3 acres and your house sat on 1 acre and you had 2 separate acres. 2 separate acres. Well, as long as you sold that land within the 5-year time frame, you lived in that house for 2 of the last 5 years, if you sold that land in that 5-year time frame, you could potentially not pay taxes on that as long as you utilize that land while you live there. And vice versa. Maybe you sell the land first and then a year later you sell the house. As long as it's in that 5-year time frame, you won't pay taxes on the gain from that land. So if you're married, you get up to $500,000 total on the house and the land, all 3 acres. And if you're single, it's $250,000 increase in the price that you'll save as far as capital gains. So you definitely want to have your CPA check this out. And guys, here's what I found out about CPAs. Most of the time, CPAs will not tell you, hey, you sold the land, then you sold the house, you're eligible for a $250,000 no taxes if you're single, or $500,000 if you're married. You want to approach your CPA and bring them this knowledge. Again, I'm not a CPA, run this by your CPA, but they can look it up in the IRS tax code, the sections, and it's called the homeownership tax. The next is like-kind exchanges, or 1031 tax exchanges. You know, this has become something that's been thrown around so much, but it's basically IRS code 1031. That's where the 1031 came from. So I'm going to really break down the 1031 tax exchange, but really I want to just simplify it very easily here. So a 1031 tax exchange is called like-kind exchange, but you can exchange from one property to another. This does not work for your vacation home and doesn't work for your primary residence. But let's just say, for instance, I purchased a piece of land 10 years ago and I sold the land for $50,000. And I want to take all the profits from that land. So let's just say I bought it for $1,000 and I sold it for $50,000 10 years later. That's a $49,000 profit. Well, I can't use the homeownership because my home was nowhere near this piece of land. So I'm going to take this $50,000. I got $49,000 profit. I'm going to take $49,000 and I'm going to put that as a down payment on a duplex. That's going to cost me $490,000. So I'm basically putting 10% down for that duplex. This would be considered a like-kind exchange because I'm buying a more expensive asset. or I could technically put that as a down payment for my home. It works. You want to do this with a actual qualified person. You want to talk this through with your CPA first and have this planned out in advance and make sure that you do everything in a specific structure. But at the end of the day, all we're doing is we're taking the profits from one and buying a more expensive piece of property on the next, and you're eligible to write off the entire $49,000 profit made on that property. So here we go. I'm about to break it down a little bit more. I'm going to break down exactly step by step of a 1031 tax exchange. But before I do, smash that subscribe button. I come out with these videos 5 days a week. I'm always sharing great content as far as what we're doing in my land business, my house business, and it will help you save money on taxes as well as make money in land. So go ahead, I'm waiting, hit that subscribe button. All right, so one thing I wanna mention about 1031 tax exchanges or like-kind exchanges is there's no amount that you can do. You're actually not limited by the amount of these that you do or the frequencies that you do. So remember I talked about that piece of land and then it turns into a duplex. Let's just say you sell that duplex 2 years later, you purchase it for $490,000 and you sell it for say $690,000. You have a $200,000 profit, 2 years, you rented it out. Now you're gonna take the profit, that $200,000 profit, and put that on, let's just say, a $2 million property, which it probably wouldn't work because it's only 10% down, but just for this example, we're taking that $200,000 property and putting it on a down payment for a $2 million apartment building. Let's just say this apartment building has 9 units. So you're constantly trading up and you're allowing your investment to grow tax deferred. I say tax deferred because if you ever sell that 9-unit apartment building and you don't do another 1031 like-kind tax exchange, you could potentially be taxed on your what you depreciated with those properties as well as your gains. All right, next I want to talk about the timelines of a 1031 tax exchange. So if you're going to sell the property, I want you to know about the 45-day rule. So you have 45 days from the time you have closing, you close on the property. Now you have 45 days to name your 3 properties that you're looking to buy. It could be one over here in Orlando, Florida, one in Fort Pierce, Florida, one in Vero Beach, Florida. You have 45 days to get that. And then the next one is the 180-day rule. This is 6 months from that time that you close on your property, 180 days to close on the property that you're acquiring. Now, once I did a 1031 tax exchange on my triplex, I bought 2 additional houses with the triplex funds. There's no limit to the amount, but each one of those were actually more expensive than the triplex. So I ended up selling 1 property and buying 2 with it. So I told you I was going to talk to you about 2 strategies, but I want to give you a 3rd strategy, something that I use in my land company because we've done over 310 land deals. And we have over 114 notes paying us every single month. So technically, I'm not doing a 1031 tax exchange every time we sell a piece of land. But what we are doing to defer our taxes, to lower our tax bill, is we're buying apartment housing, we're buying single family homes, and we buy office space. Anytime you buy a rental, and another one could be even an Airbnb or a vacation home, as long as you're using it as a rental. So every time we buy these, we're actually depreciating these properties and lowering our tax bills every single time we do it. So this is extremely powerful, and I want you to talk to your CPA about this too. You can even consider something called cost segregation, to where it's at the end of the year, like you actually can segregate all your properties and look exactly each one, how many doors and windows and all these things, and you kind of break down the property. And at the end of the year, like you can actually reduce your tax bill from like $100,000 or $85,000 down to nothing as long as you purchased enough rentals. So I want you to be pre-planning this with your CPA if you're selling a parcel of land or selling multiple parcels of land. This is higher level tax strategy stuff. You can definitely get in trouble if you don't do it correctly. So you want to make sure your CPA understands cost segregation and a deal in real estate. So guys, as you know, I said I've done over 310 land deals. I have 114 notes paying us income each month. If you're looking to start a business like this that serves you, your family, and others, head on over to thelandsharks.com. Schedule a call with me and my team. We'd love to see what your goals are, and if we feel like we're a great fit, I'd be honored to coach you.